says I can't bring her on camera. What's happening? It's adding. Let's see if it works. Connecting. Hello.
Hi, how are you doing?
Finally.
Imagine, like we were struggling.
Hey, technology.
I literally had
Technology is.
no, I literally had to go and like update my Facebook because I couldn't see the request thingy, like request
Oh,
to join thingy. So I just
you're not
yeah,
a
I updated
you're not a
everything.
Facebook person, hey.
No, not
I can
really.
imagine. I can imagine.
Yeah.
So how are you? How are you
Yes.
doing?
I'm doing great. I'm doing
Eh?
great, man.
You're at home, eh?
It's just cold, as you can see.
You're at home.
Yeah, I'm at home. I'm at home. Yeah.
Oh.
Republic of Venda.
Okay. So
Yeah.
thank you so much for agreeing to do this. We really appreciate it. Maybe I don't know. I don't want to do the introduction myself. I want you to introduce yourself. In terms of perhaps what you do on a daily basis. That perhaps qualifies you to talk about these issues at the topic at hand today. Oh, because all I know is that you're an actuary.
Oh,
I
okay.
hardly know what you guys do on a day-to-day basis, and I think a lot of people don't know. So I guess
Okay. Oh,
you can fill us up on that.
okay. So I am Fulufhelani Shapa, and I am what an actuarial specialist at Old Mutual.
Yeah.
So what we do on a day-to-day basis. So you have an insurance product, right, that people buy from either brokers or intermediaries of any
Mm,
form,
mm,
right? So actuaries are literally the people behind the
mm,
numbers in those contracts. So the people calculating how much premium you should be paying, the people calculating the amount of
yeah.
reserves that the insurance company should
Mm,
hold, yeah, right, for your policy, for them to be able to pay out your
mm,
policy. So we are also the people behind risk
mm,
management, and this can be risk management in any organization. So it can be a bank, risk management of an insurance company, risk management of any company.
mm,
So that is literally what we do on a day-to-day
mm,
basis. And depending on, which department you're in, the work that you do on a day-to-day basis will be
yeah.
different. So when it comes to me, I get to do like a lot of actuarial
Mm,
work, sort of like things that a person in one department won't be able to do because our team is structured in such a way that we are like consultants for 9 African countries which
okay.
Old Mutual operates in. So we get to see reinsurance, we get to see, just normal general insurance
Mm,
policies, under which business insurance is included. And we also get to see a bit of risk management overall,
mm.
like managing your financial risk,
Okay.
managing, your 9 financial risks like protests and all of that.
Mm.
So in a nutshell, I know I can go on, but in a nutshell,
I mean, I
that is
could
what
tell
we
that
do. Yeah.
you're speaking from a point of passion. You're so passionate about what you're talking about, which is a good thing. So maybe in a simplest term, right? What does it mean when I take an
Yeah.
insurance contract? What does it mean? And maybe from a business perspective
Oh, wow.
and from an
Mhm.
policyholder perspective.
So when you take out an insurance, you are in essence buying a promise from an insurance company.
Mm,
And the promise that you're buying is that in case an insured event happens, so insured events they can be very different, for different policies, right?
yeah.
So in case that thing happens, you are in essence buying a promise from an insurance company to say you will step
Mm,
in and pay for the damages that I would have incurred, in the event that that particular thing
mm,
happens. So this whole thing is like literally based on trust,
Okay.
because upfront you're not sure whether they'll pay out or not.
Okay.
So the whole transaction is based on trust, and what you're essentially saying is, I'm paying you for this protection that you're giving me, that you know you will step up when the time comes. So in a nutshell, that is the whole transaction behind insurance.
So I guess the main reason, maybe what sparked this conversation, is we've seen what has been happening in our country, the looting and everything. Is such events an insurable event, if I can put it in those terms?
Oh, well, so let me just, you know, teach you a bit, school you a bit about insured events, right? So when we say that an event is insurable, what we are essentially saying is, this is an event that a policyholder has an interest in. So there must be an interest to begin with. That's where we bring the concept of insurable interest into play. And we're also saying, in case this event happens, there should be a financial consequence, you know, that you as a policyholder should incur, right? And then the last part is just that whatever amount we are paying you as an insurance company should have a relationship somehow with the loss or the damage that you would have suffered. So now there are like a variety of events that insurance companies sort of cover you for. And a lot of those tend to have a very low probability of happening. And when we talk of, you know, unrest, political unrest and all of that, it can be considered to be an insurable interest, but not everyone has the capacity to insure you for that event. Because it's an event that is unlikely to happen, number one. But if it happens, as we've seen in the previous weeks, the damage that can be incurred can be a lot. We are speaking billions of rands. So no, it's not everyone who's able to insure such an event. So I hope that answers the question.
Yeah, definitely does. But then it begs the question, who can insure such events? Because I mean, you can never predict when they're coming. You know, you don't want to take the risk as a small business to think, that such event is has a remote probability, but then it happens, like it happened in the past few weeks. Then what must happen now? So who has the capacity to actually take up such level of risk?
I'd say the government. And when we say the government, in essence, we're saying it is the people, us, through our taxes, who in essence we are funding this type of insurance, or who can sort of be, I don't know, serve as surety or security for such events happening. And if there's a need for a bailout, then, you know, we can sort of step in one way or the other. So in South Africa, when we say the government, that's when we speak of SASRIA. You know, that those are the people that it's like an insurance company that is owned by the government. And we do believe that governments have deeper pockets compared to private companies. So for events like that, they have the capacity. If they don't have capacity, they have the means to increase capacity to pay out for such events happening.
Okay, that makes sense. Maybe, so, you know, the damage for such events could be so severe, as we have seen, right? Some of the malls have been damaged beyond repair. So what's the level of premium that we pay, that a policyholder could pay in such events, you know, in order to be covered for such risk? Do you have an idea in terms of a range, perhaps, how expensive it is?
Okay, for your small businesses, it will be somewhere around 1.5, 1.7. But then with bigger businesses, this thing is not like an exact science, because every business is different, and it depends on what kind of business are you in. You know, do you have property? Do you have content that you're insuring? Do you deal with stock? Do you deal with service? What risk can arise from the business that you're insuring? So for bigger businesses, it can be a lot. We're talking thousands, 20,000 something, if you like a big multinational company. But if you're a small business, then you can play around between 1,000 and 2,000 range. But it depends. It's not something that I can just say, oh, the price is this much for, your business, because we take into account a lot of factors before saying that answer.
Maybe let's bring it back to like natural persons. I just saw on I think when I was getting my car contract, I saw they were suggesting Sasria insurance, but I saw the premium was like R2 and stuff like that. Then how would Sasria be able to cover my level of risk when my premium is so low like that? Do they actually share the risk with someone else? Maybe I think that's the concept of reinsurance, to actually cover that level of risk in the event that such event that of looting, etc., happens.
Okay, so let's just backtrack a bit to talk about Sasria and how they fit into the whole insurance industry market, right? So Sasria was founded in 1979, and the main reason why we have Sasria today is because insurance companies realize that they don't want to insure political risk. So your political unrest, your riots, your strikes, and all of that, they consider that to be high risk, and they were like, we don't have capacity to actually insure these events, because the claims that can arise from those events, they can literally wipe an insurance company out, right? So then government then came in and they were like, okay, since insurance companies are not going to insure this risk, political risk, we are going to form an organization, but in essence, an insurance company that will deal specifically with such risks that will be normally excluded in your normal business insurance contract, for example, right? So in essence, how Sasria works with insurance company, they say, for a policy that Shipiwa is buying from, insurance company XYZ, we know that in that policy, the insurer has excluded political risk. So anything that may happen to your business as a result of, political unrest, strikes, and all of that, it's not covered, right? So they come in and they're like, hey, Shipiwa, on top of the policy that you have with insurer XYZ, you can pay R2 to actually be covered for political risk. So if there's terrorism, if there's strikes and your business is affected, which, a normal insurer will say, we're not going to pay out because that is excluded. That is, it's like it's beyond our pay grade. In other words, we're not going to pay that out. Then Sasria will come in and be like, because you've been paying R2 on a monthly basis with us, we're going to pay out for this event. So that's how they work with insurance companies. So in essence, it's like they insure a part of your policy, not the whole policy. Yes.
That makes sense. So maybe now the question is, if, for instance, I'm paying that R2 and stuff like that, how do is the claim the cost of the asset that I lost? For instance, if we're taking it to the small businesses now, so is the claim the actual cost, or is the claim the selling price of the asset that perhaps I sell on a normal basis? Say, for instance, I sell furniture, right? So when I claim, do I claim the selling price of the furniture, of the stock that was looted, or do I claim the cost price of the furniture that I bought it at?
Okay, so when it actually comes to that, it depends, right? So insurance companies, it's like on your normal motor insurance, right? You can insure your car on market value, for example. You can insure your car on retail value. You can insure your car on I forgot the last one. But like there are different, values that you can insure your car. So it goes back to your contract where you insured under the cost or the selling price of the value of your goods. So that will be agreed upon. It's one of the options that you need to select when you buy, your insurance, to say, am I insuring on cost or am I insuring on, the selling price? So it depends.
Okay, that makes sense. And how do I make sure that I get is it possible to deal with Sasria directly, or do I deal with Sasria through a certain insurer like Old Mutual or Sanlam, etc.?
So you're supposed to access Sasria through all the insurers in South Africa, the ones that are offering you any type of insurance. So you don't deal with them directly. it's like when you're buying, you know, car insurance, then you can request to get cover from Sasria. So then it will increase your premium by 2 rands or whatever amount that is, you know, required.
Okay.
But you don't deal with them directly. They don't offer, you know, like a policy for political risk to the public.
Okay.
But it comes with other policies that are sold by insurers. So the cover is not automatic. You have to like ask for it. So when you're buying your business insurance, then you need to explicitly say, can I request to be covered by Sasria? You know, on top of the policy that I have. It's something that you must request. It's not like an automatic cover.
Okay, that makes sense. So I want to go back to pricing, right? In terms of how do they determine the premium that I get? So we spoke about the different level at which you could cover your assets, right? For any for the risk of political unrest. So does the price increase when I cover through maybe based on market values as opposed to based it on cost value? And is there difference fundamental, or is it not? It doesn't depend on something.
Okay, so yeah, it has to actually depend on which cost you actually, or which amount you actually cover it on, right? So if it's market value, then you would expect your thing to be higher, your premium to be higher. And also, we don't only just take into account that we're covering you on market value, but we also need to take into account the fact that, you know, what is included actually in your cover, right? What are you covering on market value, and what is the value of that particular thing when you actually take out your policy? So it's a variety of factors that we're considering. And also, when we look at your business overall, how exposed are you, you know, to such risk happening of fires or like such risk of political unrest? We do consider that when we determine your price. So it's also just us looking at a whole bunch of factors and using our model, then determining because you have certain characteristics in your business, does that make you, you know, more likely to claim or not? If it makes you more likely to claim, then we have to, you know, your premium has to show that you indeed are more likely to claim.
Okay, that makes sense. So since we now know that Sasria covers the political unrest risk, so say for instance electric faults, fires, and the likes, are they covered by the normal insurers, your Old Mutual and the likes?
Yeah, no, those ones are covered by your normal like insurance companies. And I think it's also that thing where you have to, when before you buy your policy, you need to ask what is excluded.
Okay.
Because we do know that, you know, policy documentations have, you know, those underlying those very small prints and all of that. So you do need to just take that into account. But normally your fire will be covered under a normal policy.
Okay.
So damage occurring to this as a result will be paid out by your normal insurance.
So when I received my policy documents, there were such a long documents, legal documents. You know, not everyone has a background in legal things to comprehend such level of documentation. Do insurers actually take time to actually explain those things, or do you have to specifically ask to be explained and walk through the documentation?
Okay, so as part of the normal, you know, sales process, they should actually walk you through the documentation and explain to you, you know, the exclusions, explain to you the different terms of your cover, right? So that you as a consumer, at the end of the day, you actually buy knowing what you're actually buying. So it is, but we do know, man, in practice, you know, people are chasing sales. Those people are paid on commission. So some people might actually rush through the process. And also as consumers, we might actually rush them through the process because we want, you know, to get the cover as soon as possible. And we don't want to go through the whole process of going through legal documents and all of that. But they should send you the policies, and you should you should read the policy. And if you have any questions, you should actually ask them back to say, okay, I see this term or this exclusion clause. What does it mean? So I feel like we can't really put the responsibility on the insurer.
Okay.
We as consumers also have a responsibility to understand what we're buying. And I do understand legal documents are really heavy. I also sometimes need like assistance to really understand what my policies say. And imagine I work with these policies, but as actuaries, we also need assistance from lawyers and all of that. So it's like joined, combined efforts from both sides, the consumer and the insurer. We both need to come to an understanding of what is this promise that we're giving each other, and what does it mean? What is excluded? You know, what is in this relationship that we're in, and what is not.
Okay, so maybe just dive a little bit on the number of factors that are considered when a premium is determined for, say, for instance, you're trying to cover your assets, you know, for the business, be it you're covering your building in case it collapses for any catastrophe that could happen, or fire, etc.
Yeah.
Just maybe elaborate and add some color on what factors actually you guys consider when you do your pricing.
Okay, so there are different policies, right? There are smaller. I just thought I should, you know, put this out there. There are smaller, like business insurance policies that are specifically aimed for small businesses, where you would be charged your premium based on, you know, what's your profit, you know, turnover, what's your profit, also what assets do you own. Those are the things that they consider. And since they are literally focusing on encouraging smaller businesses to actually get insurance, then you do not get penalized as much as someone who has, you know, a multinational global business with a lot of assets and all of that. Because at the end of the day, we understand we cannot charge both of you the same price because you're in essence in different stages of your life. But other things that we consider, of course, is the line of business that you are sort of in, right? Are you selling a service, right? Are you selling a product, right? So if you're selling a product, for example, something that people apply on their skin, we need to consider the type of product, the packaging of your product. We also need to consider what are the possible long-term effects, you know, of your product, because we do understand we might actually not understand what the impacts are now, but then 10 years later, someone can come and sue you for your product causing damage to their skin or whatever. So those are some of the things that we consider. We also consider location. Like, where are you? Where's your business located? Are you in a rural area in Limpopo? Are you in Joburg, for example? For people who are in Joburg and also people who are in Durban or KZN, what we can expect to see in the next coming years is the cost of business insurance is likely to increase as a result of insurance companies trying to recoup the capital or the amount of money that they're going to lose, you know, as a result of all of this. So that is what we can, like, in essence, you know, say, okay, the location of your business actually matters. If you are in Joburg, then we would consider you to be, okay, we saw what happened in 2021. This area is very risky, but you do have remote areas that were not affected. So those are some of the things. Also, like, your business, how do you operate, right? Do you operate, you know, virtually? Do you have a physical building that you occupy? So then that just increased the number of risk because we're looking at fire. What if there's a fire? What if there's flood? Are you located closer to a river, to a point where you are affected by floods, for example? So those are some of the things that we take into account when we're trying to price your insurance overall. How many employees do you have? Do you have any cover that you want for your employees as a result? So yeah.
That makes sense. That makes sense. I guess the biggest question in probably most of people's minds right now is, the insurance company is taking all this risk on their balance sheet. How do they make money? How do they make money to ensure that they've got enough assets to actually pay out when I say, you know what, there's a fire in my business and I'm covered for this? How do they make money to make sure that that level of risk, when I claim, they actually pay out my claim?
Okay, so let's go to the fundamental, right, of why insurance actually works. Why it actually works is the law of large numbers. So what we're essentially saying is, if you group a number of people, a very large number of people, the outcome, right? So outcomes in terms of the number of people claiming, the amount relatively of the claim somehow becomes predictable. And because you group a number of people right together, in an ideal world, we would say these people are similar, right? So they're similar in terms of this is the business that they're doing or whatever, right? If you group them and they're similar, what you're essentially saying is at the end of the day, not every one of them will come and claim, right? You will have, and the larger your group is, the more you expect like only a few people to actually claim. So that's how we actually, stand to make money as insurance companies, because then we are like, we have all those people paying us premiums on a month-to-month basis or annual basis or quarterly, whatever the frequency. And out of all those people who essentially give us their money, not everyone will claim. So in essence, you have people coming together, crowdfunding, and I don't really want to use the word crowdfunding, but it is in essence what is happening. And as an insurance company, we will take your money, we will invest your money before whatever thing you claim for happens, and we make returns from that. And as actuaries working behind the numbers and the sort of the modeling of the claims and the modeling of the behavior of the consumers, we tend to say, okay, this is what we expect. When you take out your policy, we're like, this is what we expect to happen. These are the number of people that we expect to come claim. These are the number of people that we need to actually buy their policies. So we make projections and we're like, if things happen the way we expect, this is how much profit Old Mutual can expect to pay, right? But if it turns out that we estimated that, for example, 200 people will come claim and only 5 people come and claim, then that means we actually we make profit from our experience being better than expected. So in essence, it's a combination of factors. It's experience overall being better than what we expect as an insurance company, and you guys bringing us the premiums, reinvesting those premiums, and hopefully making positive returns on them, and then that sort of works together in our favor. So we have enough money to actually pay you out, but we also have enough money to pay our shareholders, give them the returns that they need.
So in essence, it's not actually a scam, hey?
No, I feel like it's smart math. I would definitely say it's smart mathematics with very smart people working behind the models and making predictions about the future. But also what I really, really love about it is that sometimes we get it wrong, hey? And that's where we learn, like the pandemic. We didn't see any of this coming. No one saw last week, they had the events that happened last week coming. And it's just a thing of going back to the drawing board and looking at our experience and saying, how could we better prepare for such an event happening? It's smart mathematics.
It makes sense. That's why maybe I didn't enjoy probabilities in high school. That's why I'm an accountant. Anyway, so
it's not for everyone. You might as well just leave it for actuaries to deal with the statistics and the probabilities.
I wanted to, maybe for you to add some color on what happens when I've taken an insurance contract, right? And I've been paying this contract premiums for about, I don't know, I covered my business for about 5 years now. But it comes to a point where business is not making enough profits to actually cover some operational costs. And insurance, I mean, it's an easy dispendable cost, right? So I say, you know what, I'm going to cancel my insurance. So what happens to all my premiums that I've paid for the past 5 years?
This is an interesting question and also very sensitive because this is why people hate insurance. People hate insurance for the same reason. So what we essentially talking about is what we call discontinuance, right, of your policy. So discontinuance of your policy can happen in 3 ways, right? So the first way is you can lapse your policy. So you lapse your policy, you don't get anything. Like you just walk away. You cancel your policy, you walk away. There's nothing that you get paid out of that. Yes, I know this is sensitive, but in essence, your premium, this is why people hate insurers. But listen,
Yeah.
your premium, right? Okay, look at it this way. When you give, Old Mutual 500 rand on a monthly basis, you're in essence paying for protection. They give you protection for a month, right? And then you pay another premium. They give you another protection for another month.
Okay.
As you pay, they continue to give you protection. So if something happens, they pay out. If nothing happens, you got the protection that you needed for that month.
Okay. So that's the game.
When you stop paying, yes. When you stop paying, right, you are in essence saying, I don't need your protection anymore. Stay away from me.
Oh, makes sense.
So from that perspective, we both, played a part. But as human beings, as consumers, we don't understand that part. Where in essence say, I've been paying you money, for all these months and nothing happened. I deserve to get my money back. But what you don't realize is that for all those months where you were covered, the insurance company was literally taking on the risk that something can happen to your business. So when you walk away, we have both fulfilled our obligation to the contract that we were in. I gave you protection with the promise that if anything happens, I will pay out whatever damage you incur. And you enjoy the protection, knowing that if anything happens, then the insurance company will pay. So now when we part our ways, we both come to an understanding that I received protection for as long as I was paying for it. And now because that I don't need that protection anymore because of other reasons, I can't pay or whatever, then it's okay, we both walk away. There are such policies, right? And then you have the second type of discontinuance, right, which is called surrender. So when you surrender a policy, the policy contract will stipulate how much surrender value, not really the value, but how your surrender value should be calculated. So then you surrender the policy, and then they give you some, some form of lump sum to sort of say, okay,
sounds like a
you
fair
surrender
deal,
your policy, this is how much. Yeah, that is like, yeah, that is a fair deal. Then they give you that. And then there's the last one, right, which is called a paid up value. So what in essence happens is if you were covered, for example, for up to 1 million rand of damage in your business or whatever, what the insurance company will say, okay, since you can't pay your premiums anymore, right, what will essentially happens is we will continue to cover you, but you will not pay any premiums anymore, but we will reduce your cover based on how much premiums you've given us. So from 1 million, you might move to being covered for like 100,000, for example, depending on the premiums that you have actually given us, sort of give you that amount of cover. So all of this will be written in your policy. It's something that you have to ask, is there surrender value for this, contracts that I've actually taken up with you or not? But, most of the time, it's actually not. In South Africa, you rarely have policies that give you surrender value. For example, especially with your short-term insurance, which, your business interruption or your business insurance falls under short-term. Those policies rarely have surrender values. So what will happen is if you can't pay anymore, chances are you're not going to get, any money back because you've been given protection for all those months. So that's how you look at it when they say, we can't pay you any money. You essentially say, okay, I enjoyed, protection for Old Mutual for 11 months. I've chosen to walk away right now, so they don't owe me anything. Yeah.
That makes sense. I guess it's important to.
Is that fair though?
I guess it's important to always talk about the exit strategy on the contract in case something else happens and you cannot afford premiums. I mean, life happens even on our personal lives, even on the business. Stuff like this happens. Okay.
Yes. And also I think what I just have to put, insurance on the map because I believe we get so much bad reputation and sometimes I'm just like, we do good, you guys don't recognize us for doing good. I mean during the pandemic, even like last year, even this year, some insurers went to a point where they say we're giving our policyholders a premium holiday. So we understand that business is slow. We understand that, you know, you're not getting as much money as you were getting, but we're giving you a premium holiday for 6 months. So in the 6 months, you don't pay the premium, but we have still, like, you still have your cover.
Yeah.
So I feel like that's another, you know, I mean, give us a pat on the back as insurers. We are trying to meet you halfway.
Yeah. Yeah, that makes sense. That makes sense. That makes sense. So maybe let's talk about the claim side. Hey, so what instances do insurers not pay claims? You know, like what could prevent me from getting my claim from an insurer? Because we've had a lot of news saying no, Old Mutual is not paying this claim, etc., etc. What are the reasons that would cause an insurer not to pay out a claim?
Okay, so if you were caught doing something illegal, then they're not going to pay out. What do I mean? You have a business, you find out that your business is not doing well. You then, you know, I guess, go call your cousin and be like, my business is not doing well, but I have business, you know, cover, business insurance with Old Mutual. So in essence, please go ban my business, burn it down, and I will claim from the insurance company, right? I mean, this is like a whole extreme. I'm not giving people ideas actually, don't do it. This is like a whole extreme example, right? And of course, insurance companies won't just, you know, you won't just submit a claim and then they pay it out, because we do understand that there are people who are literally in the business of fraud, you know, they submit fraudulent claims. So we need to then adjust, you know, we need to then come and inspect, do investigations, determine how much we are actually liable to pay you as Chipiwa, right? Because of the loss that you suffered from this fire in your business. So then if we are doing our investigations and we do find out that, you know, it's actually this thing was all orchestrated by you and your cousin, then they're not going to pay out, which I believe that's a fair deal, you know, because you were trying to cheat and rob the process. So then they won't pay out. Okay. And then you also have situations where insurance companies are like, but Chipiwa, you don't have insurable interest. And this is what makes a lot of people angry, because you're like, I've been paying premiums and you're only telling me now that I don't have insurable interest. And sometimes we don't really know that you don't have insurable interest on the outset when you send me the policy, because you as a policyholder do not disclose all the information. So in essence, you get into a contract, but you have sidelined the insurance company. So they do not know some things that you know, right? Okay. And then all these things come into surface when you claim, because now we are like, okay, cool. Whose business is this? It turns out this is someone else's business, right? So then they'll start asking, but how do you have insurable interest? You know, do you own a part of this business? And you're like, I don't own the business. So why would you insure someone else's business, right? Okay. Because then what that means is you can literally bend the business, suffer no loss on your side, and then paying for the insurance paying from the insurance company, right? Get the money, but then what is your interest in that situation? You know, you are literally just playing daylight robbery. So those are some examples. And I also think a cool example to sort of, you know, close this conversation or like close this question would be, for example, you get into an accident, right? And it's national lockdown, right? You were not supposed to be traveling to Gauteng or from Gauteng. You get into an accident. In essence, you are doing something illegal. You're traveling and you don't have a permit to actually travel. You get into an accident. An insurance company can be like, we're not going to pay out because you were doing something illegal. So it doesn't have to be extreme. It can be as simple as that, to say, well, you don't have a permit. You are going against national lockdown regulations. This is illegal. So we're not going to pay out.
Sure. Yeah, hey.
Yeah.
It's tough. It's tough.
Shocking. And I think that's also where, I mean, it causes a lot of conflict. And I can imagine if you're on the receiving end, you would be very frustrated because I've been paying my premiums. You know, we have I guess as consumers, we have the mentality to say, if I give you my money, you must just pay out. And insurance companies are like, wait a minute,
There
that's
must be some.
not how it works.
But I
So,
mean, why
yeah,
is it that
that's not how it
why is
works.
it such level of investigation or is only done when you claim, and they don't necessarily do all this investigation, risk, and all of that? They just ask you some simple questions, like, and then
Yeah.
it's all done. You complete the contract. But when now I want my money to be paid out, it's all different ball game. Why is it like that?
Yes. Mm. Okay. So, I mean, that's an interesting question, right? It all comes back to consumers,
Yeah.
right? At the end of the day, when we put out a product, to the market, right?
Mm.
What we're in essence hoping is that you get to disclose, all the information that we ask from you. You don't lie to us, you don't withhold any important information from us
Mm.
and all of that. But at the same time, balancing getting as much information from you should come with, the sales process not being too long.
Mm. Okay.
And us also not incurring, a lot of costs in the underwriting stage. Because then the risk that we run into as an insurance company is that we might actually hire like 5, 10 underwriters to come to your business, assess everything, assess, every spoon that you use, every machine that you use, and all of that. And we will incur a lot of costs in the beginning,
Okay.
right? And so how do we recover that cost? We have to recover that cost through the premium, right? That you will be paying to us.
Okay.
So the premium might actually end up not being like affordable to you as a small business,
Okay.
right? So we also have to balance that out with saying we want this to be, marketable. We don't want the sales process to spend like 20 years because we going from this person to that other person trying to sort of analyze and determine the risk that you pose to us as an insurance company. So, but at the same time, when it comes to you claiming, right, we're also trying to, in essence, balance the same thing. But here, the ball game is that we don't want to give you more than enough money, compared to the loss that you've actually incurred. So, in essence, we're trying to say, how much do we actually owe you? Do we actually owe you? That's the first question. Do we actually owe you, right? If we don't owe you, then why should we pay you? So I know it's one of those things.
It's
We have to balance out things. We can't just pay. We need to make sure that we are liable to pay.
Okay.
And a biggest factor, especially when it comes to, your business insurance, is that we don't really take all the risk. So as insurance companies, we also get insurance on the risk that, we take from you as consumers. So there is the whole concept of reinsurance. And reinsurers won't pay unless we as an insurance company actually show that we're liable to pay the claim, which is why you now drag into court cases and all of that, because we want to determine, are we liable, first of all, and secondly, how much do we owe you? And most of the time, it becomes a whole, lawyers' battle where they're like, no, we're not liable. Then they bring up all these things, all those little issues that were not like raised in the beginning when you were buying insurance contracts.
Yeah.
So I think this one we can blame it on lawyers as well.
Not you guys externalize.
We can blame it on lawyers.
It's always the lawyers, isn't
it? We can blame it on lawyers. Yeah.
Okay, so I'm gonna take some few questions from the comments. So one question was, with the political unrest risk, who actually prices it? Is it the insurer or Sasria? I think you've answered that, eh? Or do you want to add a comment on that?
Yeah, no, it's Sasria.
Okay.
Yes.
Because I think they also published some document about their pricing, hey? Okay, and
yes, they do. Because they're in essence an insurance company, if you look at it.
Okay.
But it's an insurance company that is embedded within other insurance company, or they work closely with other insurance companies.
Okay, that makes sense.
Yes.
And someone said, Zubia says, how is it that when an unfortunate event, like say for an an accident or something happens, and now all of a sudden your premium goes up? Is it because they think you are a higher risk than you were before?
Okay, so in insurance, in pricing, right?
Yeah.
If you look at it from actuary's point of view, we are in essence saying this is Chipiwa, this is his profile, right? This is how many claims we expect him to actually, bring to us and all of that. He's less risky or more risky, depending on a lot of factors. So we then, we're literally using models and numbers and past experience to come to a price, right? That we would say, okay, this is the price. But if we sell you insurance, and normally your insurance, car insurance, for example, is renewable on a yearly basis, right? So after a year, we look back and we're like, we thought Shipiwa would not claim at all. But Shipiwa came with 6 claims in 1 year. So what that tells us is we underestimated the risk that Shipiwa poses to us as an insurance company. So then, because we didn't assess your risk in a right way at the beginning, we now have to adjust your premium to say, okay, cool, this is what's going on. But you also have other insurance companies that will say like, no, your premium won't increase for at least a period of a year, right? They will increase next year when they renew your contract. So there are variations when it comes to these things. But yeah, we are just saying we were wrong, mainly wrong about you. So we have to adjust.
That makes sense. Sakiwo says, risk calculation of livestock for a stock farming business. Perhaps how do you quantify that risk on livestock?
On livestock,
like your cows.
Okay, so
how do you?
Your cows and
the
your
goats and the sheep.
Okay, so in and the chickens and the pigs. So normally how we sort of like determine that calculation would be the probability of that event happening. So whatever event, is it fire, is it theft, is it whatever, the probability of that happening, and multiply that by the amount. So what amount do you stand to lose? For example, if you sell your cows at 1,000 rands, or example, 1,000 rand, no, not 1,000 for your car, 7,000, 8,000 for your car, then the amount in essence, will just be what is the probability of your cows being stolen, multiplied by what number of cows, or the total amount that you stand to lose from someone stealing your cows. And then we do that for different risks. So there is theft, there's fire, what if there is like an earthquake that kills you, thing. So we do that with different probabilities coming from, of course, past statistics, in South Africa, to say what is the likelihood of there being a flood in this specific area, what is the probability of your cows being stolen in this specific area. So it's, I guess I'm simplifying it a lot because we do have to make adjustments for a lot of things. But in a simplified way, it's just probability multiplied by the amount. So then you get to sort of see how much you stand to lose if any of those happen.
That makes sense. I mean, it's smart maths after all.
Exactly. See, you get it. You get it. Yes.
So,
smart maths.
This has been very educational. And I think I've learned a lot, and the audience probably has learned a lot too. Maybe I just want you, in closing, to sort of like, what's your advice for small businesses out there in terms of ensuring that they are covered for whatever risk that may be facing them, however remote it is, and they may think it is. Like the events of the past few weeks have shown that nothing is as remote as we think it is. So what is your advice on small businesses regarding insurance?
I'd say, I mean, when it all, okay, as individuals, we have a tendency to underestimate the amount of risk that we are facing. As you were saying, nobody thought looting could cost, between 10 and 20 billion, in a space of a week. It was just like a distant thing, a distant possibility, but it happened last week. So in the same spirit of saying, you never know, if you know that if such an event were to happen to your business, if you know that you won't be able to recover from it, then I'd suggest, you might want to start thinking about insurance. And also just because it's political risk and it's something that looks unlikely, 2 rands is not a lot to add to your cover. You know, if they're charging you 1.5, it's just going to be 1.5, you know, with 2 rands on top. And also I guess the beautiful thing at the end of the day is having protection would be better than not having protection at all. But at the same time, it's also very important to understand, what am I protected from? Which a lot of people don't really consider until they have to claim, right? And you actually figure out that, you know, I haven't been protected all along, but I was working under the assumption that I am protected. So really getting to know, if there's a question that, you know, you should ask a person selling you insurance as a small business, would be, I hear you, because they will of course tell you about all the glorious things about the contract. They're trying to sell you the contract, but it's very important to actually, you know, understand that at the end of the day, you know, this is what I'm protected against and this is what is not covered. So always ask them what is excluded, you know, in this contract. They won't tell you. That's not the fancy part. You don't, you know, sell something by telling people what is not covered, but it's something that you should ask, you know, what is not covered, because that will help you to make the right decision for your business. So understanding that contract and what it covers and what it doesn't cover, and also just making sure that you're protected if something happens. You know, if we were to ban your business premises, what will you do next? You know, do you have a backup plan? If you don't, then you might actually consider insurance, because that's the reason why it's actually there.
Okay, that makes sense.
Yes.
So 2 last questions from the audience. One says, would you advise risk transfer or risk retention for events such as political unrest, which is better? I think you've answered that, say.
You transfer that one. Imagine if you lose your whole business. Yeah, no, I don't know. I mean, a lot of stories that we've been hearing last week were people actually crying that, you know, I used all my savings to start this business. Imagine you've exhausted all of them. Where do you go? Like, what's next? So that's a huge risk. Insurance companies don't want to retain that risk. They avoid it at all costs, you know. It's only Sastria that is there, like, taking all of that. So I'd say, transfer that thing. You don't want to retain that thing in your balance sheet.
Makes sense.
No, like, honestly, no, transfer it. Yeah.
Makes sense. So Sakiwo says, why is it that Old Mutual, being specific, doesn't insure a digital business?
Well, this is the part where I say that question is above my pay grade. I mean, this whole conversation was literally me giving my opinions. I know I work for Old Mutual, but I am not, you know, it's not my responsibility, or rather, I don't have the power to answer on behalf of Old Mutual, because they didn't send me to come here to represent them. So I'd say, that question is definitely above my pay grade, but I guess going to customer support, Old Mutual customer support, and asking them directly would be, you know, a good way to deal with such concerns, because I don't want to be here like, oh, this is why Old Mutual doesn't, you know, and then they see this and they're like, whoa, Gelly, we didn't communicate, so we didn't, you know. Yeah, we didn't send you. So I'd say that's above my pay grade, but definitely speak to Old Mutual customer services, you know, raise that question with them. Maybe they can explain to you why.
Okay.
Hopefully they explain to you.
That makes sense.
Yes.
Last question. How does the irrational customer behavior affect pricing, especially during risk calculation? We hardly see premiums go down. Is that in any way linked?
So are we saying irrational customer behavior affecting premium? Okay. So of course, if we say people are going to behave in this way, right? If we say they're going to behave in this way and they deviate from what, you know, we have expected, right? Okay, this is what will happen. If they deviate and it actually turns out that our experience is worse than expected, then we have to adjust that in the price, right? By increasing the price. Yeah. But if we also say customers will behave this way and they deviate from the behavior, and it turns out that, you know, they behave better than what we expect, then we also have to adjust that.
Okay.
But what we normally do, we'll give you cashbacks.
Okay.
We'll increase, you know, your benefits. You know, we will say, you know, no premium increases for the next 6 months, no claim bonus, so your premium will remain the same. Or we will, okay, there are some insurers that do decrease your premiums, but that rarely happens. Normally, we find a way to sort of compensate you.
Okay.
One way that we give you money back, we increase your benefits, you know, we say your premiums won't increase when they are supposed to increase, things like that. So we do, in the spirit of being fair to you as our customers, because that's another thing. In as much as we're in business, we have to be, you know, we have to really be a responsible, I guess, provider of insurance, and we need to take our customers, you know, interest into account. So we do try, but now another thing why we wouldn't just decrease your premium, it's easy to increase, but it's difficult to decrease, because what if we decrease and it turns out we didn't, that's not your behavior, that was your behavior at that particular, you know, point in time. We have situations where a month later we're increasing your premium, the other month we decrease, we increase, we decrease. Now you're confused. There's this uncertainty regarding what premium am I actually going to pay as, you know, a customer. So we try to take away that uncertainty from you.
That makes sense. Thank you so much, Fulufhelani Mashapa, our trusted actuary who has showed and
actuary to be.
actuary to be. We're speaking it into existence, hey. But very much so.
Thank you.
Thank you so much for shedding some light on this. I personally have learned a lot, and I believe the people on the audience have actually learned a lot as well. So thank you. Until again.
No, thank you so much for having me.
All right, cheers.
Thank you, everyone.